Inflation is one of the most persistent risks investors face, and it often does the most damage quietly over time. Even when markets look calm, rising prices can steadily erode purchasing power. Today, we're breaking down an ETF designed specifically to address that risk. The Vanguard Short-Term Inflation-Protected Securities ETF, ticker VTIP. This is the ETF Investor, and this fund is about protection, not prediction. VTIP tracks an index of U.S. Treasury Inflation-Protected Securities, commonly known as TIPS, with less than 5 years remaining to maturity. These are bonds issued by the U.S. government whose principal value adjusts based on inflation data. When inflation rises, the value of the bond increases, and that adjustment flows through to the income investors receive. What makes VTIP stand out is its strict short-term focus. Every bond in the portfolio matures in under 5 years. That matters because duration is one of the biggest sources of risk in bond investing. By staying short-term, VTIP dramatically reduces sensitivity to interest rate changes compared to longer duration bond funds. True to its mandate, 100% of VTIP's assets are invested in short-term TIPS. There is no corporate credit exposure, no high-yield debt, and no tactical positioning. The fund's portfolio statistics line up almost perfectly with its benchmark, which means investors get clean, unbiased exposure to exactly what the fund promises. TIPS themselves are backed by the full faith and credit of the U.S. government, just like traditional Treasury bonds. The key difference is that TIPS adjust their principal based on inflation. When inflation is elevated, those adjustments increase the bond's value. When inflation moderates, the adjustments slow, but the principal remains protected if held to maturity. In practice, this makes VTIP behave very differently from traditional bond ETFs. Because the maturities are short, price volatility tends to be low. When interest rates move higher, VTIP typically experiences much smaller drawdowns than intermediate or long-term bond funds. That makes it particularly useful in uncertain rate environments. VTIP is often used as a defensive allocation within a broader portfolio. Investors commonly pair it with short-term Treasury ETFs, like SCHO or VGSH, or use it as an inflation-aware alternative to cash when purchasing power is a concern. It's designed to preserve value, not to chase returns. That said, it's important to understand what VTIP is not. This is not a growth ETF, and it's not meant to deliver outsized returns during inflation spikes. Its job is to quietly offset inflation while minimizing volatility. That trade-off is intentional. There's also an important tax consideration. Inflation adjustments to TIPS principal are taxable at the federal level in the year they occur, even if that adjustment isn't paid out in cash immediately. Because of that, VTIP is often best held in tax-advantaged accounts like IRAs, where those adjustments don't create a current tax burden. So who is VTIP best suited for? It fits investors who are focused on capital preservation, retirees concerned about inflation eating into fixed income, and portfolios that prioritize stability over upside. It's especially useful for investors who want inflation protection without taking on equity risk or long-duration bond exposure. The bottom line is simple. VTIP does exactly what it says on the tin. It delivers short-term government-backed inflation protection with minimal interest rate risk. It's boring by design, and in an uncertain world, boring can be a very powerful feature. If this breakdown helped, subscribe to the ETF Investor, and let me know how you're thinking about inflation protection in your own portfolio.